Hello, everyone. Thanks for watching this episode of Artemis Live. Today, I'm delighted to be joined by Michael Millette. Michael is the founder and managing partner of Hudson Structured Capital Management and an alternative investment manager with a focus on reinsurance-linked investments, but also transportation as well. Mike, great to see you. How are you doing?
Thanks, Steve. It's great to connect remotely,
Yes,
and congratulations on this whole series of talks.
thank you very much. It's great to have you part of it. For those who don't know, Mike has been working on insurance-linked securities for probably 25 years, roughly.
Nearly.
Near enough. And used to run one of the most prolific structuring and book running teams in the marketplace, now having his own boutique asset manager with a focus on reinsurance. So, Mike, I thought it'd be interesting to start off asking you for your opinion on some of the projections on ultimate industry loss from the pandemic, from the COVID-19 pandemic. Obviously, we've had a new one out today, so I wondered what you thought about that.
Well, tragedy and history. This is as near to what any of us have seen in our lifetimes, at least those born post-war, of an event affecting everybody all around the world. So it's tragic. And likewise, it's historic. Lloyd's this morning issued a $107 billion loss estimate. I expect that that's in the right neighborhood. We have been talking and thinking about losses on that scale. It's interesting though, because I think that that this is not just a gigantic catastrophe loss, although it is a gigantic global catastrophe. This is a massive horizontal loss for the industry, meaning this event is driving substantial losses in workers' compensation, in liability, in specialty property segments like supply chain insurance, cargo, event cancellation and contingencies. Also, potentially in property through business interruption, as well as losses in other areas. Trade credit is maybe the biggest compartment of all, and then losses scattered across the life health industry. So tragic, massive, and difficult to fully unpack.
Yeah. And Lloyd's estimate, of course, was initially just for P&C sector losses from the 2020 underwriting year. And so obviously we would expect that any figure for that segment you'd add to it again with life and health as well. And I think they identified the investment hit to the industry as very significant as well.
As on the same scale, so potentially 200 billion, including the total investment side hits. So that is going to be a challenge for the industry. It's a challenge that I expect the industry is capable of bearing. Those loss estimates, meanwhile, treat the business interruption loss as being a loss to explicit policies and also to some vague policies. That loss estimate does not incorporate a massive overturning of virus exclusion language in the U.S. That would be still a larger number. The industry has the capital to bear that loss, but not without some hardening across the sector. So there will be some difficulty that will create some opportunities to put capital to work, and for capital to be useful, we will of course be thinking about those.
Sure. And so from the Hudson Structured point of view, obviously for those who don't know, Hudson Structured operates a fairly broad reinsurance-focused investment strategy across a number of different lines of business, and not just the underwriting risk, but also investing at the corporate level and in startups too. So for you, potentially, do you see more or any of those lines of business that you focus on coming under pressure at all? And how do you think that will present opportunities?
Well, let's talk about four. Number one, the InsurTech moment. This is a digital forcing event around the world. There are brokers who have never filed electronically who are now filing electronically. Lloyd's is trading the bulk of its product electronically. InsurTech companies are more relevant in many ways than they've ever been. Companies that can parse wordings, companies that sell insurance by the mile are suddenly front and center. So that's an area of opportunity. There are difficulties in that sector too, difficulties fundraising. Number two, Lloyd's itself. Lloyd's has already been on a very organized campaign to rationalize pricing, to move some players to the side of the market, and that has already caused pricing to rebound, and this will cause that to go further. Number three, runoff. Companies, in order to bear losses of $100 billion on each side of the industry's balance sheet, companies will need to reorganize their capital. Part of that reorganization will involve equity raises. We've already seen that. But part of that reorganization will involve moving capital out from underneath legacy liabilities. And number four, back to cat. Now for the fourth year in a row, we have important events in and around the cat sector. Naturally, that generates some wariness, but also it will cause further rationalization in that sector. So, and we could go further. I had a new MGA for event cancellation pop up on the radar screen yesterday. How many more opportunities like that will appear?
Sure. And they're all going to need good quality capacity behind them.
Mm-hmm.
Interesting, and I hadn't planned to ask you about this, but interesting you mentioned about electronic trading and the insurtech moment, and obviously efficiency could be brought back to the fore and redoubled the efforts to achieve efficiency as well. Do you think the industry's doing enough on that, particularly in the reinsurance space and how they trade?
Ironically, everyone is so happy to be critical, but ironically, the problem that the industry has is that it was an early adopter of technology. After World War II, this industry was in the forefront of mainframe computers and data management and punch cards and the early computer languages, and the morass of the legacy of that is one of the problems the industry deals with. So the industry can certainly deal with tech. VJ Dowling, in fact, once made a very compelling presentation that identified the development of the post-war industry, the development of Bermuda as corresponding to the development of the mainframe and then of the desktop. So, we're now in the laptop, or we're in the phone era of insurance. It's the insurtech moment. The industry is used to technological revolutions. It's had two of them in our lifetime.
Yeah, no, that's really interesting. And I personally remember having to learn a bit of Fortran many years ago to help a broker out with a problem. So there's a lot of that still left in the industry's plumbing as well. So moving on, what do you think that you guys invested recently in R&Q, and you've obviously had a focus on the runoff space for a while as well. And I know it's somewhere that you were saying there was good opportunity. Probably this time last year. Coming through after the pandemic, do you expect to see a significant increase in deal flow in the runoff space?
Yes, and we already are.
Okay.
So there's been a trend in the industry. In the old days, this was a cathartic business, meaning a company had a terrible problem and they'd pay a big price and move the block of business away from them, and the markets would cheer. And now the business is becoming more hygienic, a regular activity of life. We believe that in the long run, companies will seek to originate and season businesses on their books and then to move it. And so we believe that this will become quite routine. We were on our way there. Some of the large global companies were regularly seeking the runoff market, and the corona will be an accelerant.
Right.
In many ways, this pandemic is an accelerant, and the movement toward an originate to season to seed model is one way. And it doesn't make our business just like the mortgage market. It's not originate to distribute. Companies will still need to season business, and if they do a bad job putting it together, they'll be stuck with it. But I expect that companies will seek to do a good job so that they can seed it down the road, and that'll bring greater capital efficiency.
Yeah, that's a really interesting switch in paradigm for what runoff used to be known as in the legacy market, as that takes it more to a position of adding greater quality into the book of business that you're looking after for a period of time, so that it becomes something more attractive to another capital provider?
It should be different. It should be invested differently. It should be capitalized differently. It should probably be held in different jurisdictions. And now we have, maybe a dozen runoff specialists that are doing that every day. So I think that this will accelerate that movement.
Hmm. Okay, so moving back to sort of the pandemic and specifically the ILS market, obviously there's a lot of discussion about potential implications, a lot of discussion about the business interruption issue and how that could affect ILS funds and how long they may have to side pocket assets for while litigation plays out. What's your view on this? How do you think this plays out for the industry as a whole? Is it going to be significantly detrimental to some people in the market?
Well, the business interruption issue is essentially trimodal. There are explicit coverages. There are policies where interruption is tied to physical damage, but the exclusion of virus is less clear. And then we believe that the vast majority of business has express exclusions that we expect will ultimately hold up. But of course, we don't know that. So we will either have a very limited loss from BI, a middle-sized loss from BI as less clear wordings attach, or a very, very large loss if there's an overturning of exclusions. And what will happen in the capital markets is a function of that trimodal distribution. In the first case, there's almost no impact. In the second case, there may be some impact, but it's marginal. It's around the edges. In the third case, both the insurance market and the capital markets portion of the insurance market could be profoundly affected. There's another step in the chain, which is because even if insurance companies are charged with paying these losses, it's not clear that they come into reinsurance. We expect that will be hashed out too. We expect it already is being hashed out because a number of notices have already been issued. The US and UK show some more momentum toward a fast track. And the reason for that is BI losses affect most gravely small businesses and they can't afford to wait. Sure. So I expect that those fast track processes will give us more clarity by fall. There are trial law firms that are well armed and interested in pursuing this issue. That promises some lengthy litigation unless those early rulings are clear. So there's some prospect of companies trapping while they wait. Yeah. And a larger comment, Steve, is, as I said, the fourth year in a row, we've had issues in and around the cat space, whether they're loss issues or trapping issues. I expect that that's going to put some pressures on the way that people transact in the cat space and on pricing and terms in the cat space.
Sure. We've actually already seen some of that in some of the recent catastrophe bonds, which are some of them having to have their terms adjusted, and pricing has been ramped up quite significantly in a few of them as well. On the cat bond market, is that a space that Hudson Structured looked to any opportunities during the sell-off at all? Did that aid the returns there for you?
Well, let's be clear. We are looking for opportunities across the spectrum. So cat, property, casualty, life health, financial lines, and distribution and claim services. So we look at the spectrum, and we have invested in cat bonds, and we've invested in securitizations and other lines like auto and in fact in life insurance. And we thought together with some of our LPs about the cat bond sell-off. The cat bond market tends to be a top layer market. It tends to be lower risk and return. It's not only different from the collateralized reinsurance market in form, it's actually also different in risk level. The collateralized reinsurance market tends to be a working layer market. That's more of what we do, more of what our LPs focus on. So the widening in cat bonds was interesting, but only just interesting.
Okay. And so on the sort of trapped collateral issue, I mean, everyone's talking about the end of the year as being the sort of pinch point potentially, and that if there is a significant amount of collateral trapped, which you would expect cedents to request that if they're coming to the end of their contracts and they have no clarity over BI litigation at that stage. How do you think that could play into sort of the areas like retrocession, where we're already seeing a contraction in capacity, and there were even some issues in the retro market at January the 1st, let alone next January?
It'll cause a third year of hardening.
Yeah.
Investors won't be enthusiastic to pile into retro unless there are material concessions and terms changes for still another year. I think, though, that rather than speculate about the year-end situation, we need to watch the courts. I think that in the UK, the FCA has served up 17 different language wordings to the courts and asked for fast-track interpretations. I expect to see some legal action in the US. Those legal actions may come as early as the fall and may give us some guidelines that will cause a materially different year end.
Right. Interesting. A positive year end or a negative year end, would you, or very difficult to say at this stage?
Well, I think that we rolled into this year with quite a few sectors already providing material value to investors. I think many of the sectors in the industry will present even more value to investors. So there may be issues like collateral trapping on some CAT assets, but there are other things investment opportunities that may make up for that and exceed it. So we're not just in the CAT sector. I'm not really fond of that approach to insurance. The glory of insurance as an investment vehicle is that the broad sector is not well correlated with the broad capital markets, and the subsectors are not well correlated with each other, and we're seeking to take advantage of that.
Which brings
there could be a great year end, and we could still have collateral trapping, unless everything you do is tied up in collateral trapping.
Sure. Which brings us on nicely to the investor side of the equation. Obviously, they've had 3 years where losses have been experienced, trapped collateral has been experienced, loss creep has been experienced, and obviously widely publicized. How do you think the end investors are looking at the space right now with the pandemic sort of hanging over the industry as well?
Interested, wary.
Yeah.
Interested, because let's not forget what just happened. We saw the most terrifying and astounding level of correlation across capital markets that we've seen in our lifetime. In the financial crisis, it took over a year for successive sectors of the capital markets to all crash. The capital markets succeeded in crashing from historic highs in very quick succession, one after another, in days and weeks. In late February and through March. And the need for non-correlated assets has never been greater. So interested. These sectors are still not highly correlated. Pandemic as an event is more correlated, but in general, insurance is less correlated. And I do think that most insurance-linked funds outperformed equities and high yield through the month of March, whatever the worries are in this space. Wary. It isn't, sometimes you have bad things that happen together. And in fact, over my lifetime, over our lifetime, we've seen that. We had from 1990 to 1995. What a time. We had 4 important windstorms in Europe in 1990. And actually go back, 89, we had Hugo. 4 important windstorms, Daria, Vivian, Vibke, and Herta, one after the other in 1990. And then Andrew in 1992, and the Northridge earthquake in 1994, and Kobe in 1995. It was round the spectrum, all around the planet. Everybody's worst nightmare catastrophe occurred in quick succession. Just terrible string of years. Meanwhile, before Hugo, you had to go back to Hurricane Camille to find another comparable event. In 1969, 20 years of clear sailing. We had the Capella windstorm in Europe in 1987, but it probably wouldn't have hit that much. Likewise, 1995, the industry is shell-shocked after Northridge. And then on the natural cat side, we didn't have a really profound event again until 2004, when once again, 2004, 2005, we had 7 major hurricanes, one after another. And everybody thought the world had changed, which of course meant that from the time Wilma hit Florida until, believe it or not, people forget this, until Hermione in 2016, we didn't have another hurricane strength event hit the state of Florida. So we have 4 bad years. Is every year in the future going to be bad? And the answer is maybe now we will all price very high and be very careful, and then we'll usher in a clear decade. The other thing that's disconcerting, though, about the last 4 years and the wariness is why they were bad. We did have quite a few events. One layer of the wariness is, are we having those events because the climate has changed? And there is some evidence for that. The natural cat events over the past 4 years have been water and fire events as opposed to wind and shake events. Water and fire are fingerprints of warming, and we worry. The second layer, and it's deeper, is, and it sweeps in coronavirus, is it isn't just the events, it's how people deal with the events. Every event is now a wealth creation event for everybody involved. So we have business interruption claims where they've been specifically excluded. We have contractors teaming up with lawyers in the state of Florida to gain additional funds through assignment of benefits. We have loss adjustment expenses spiraling up to the moon. So there's wariness about that. Every investor will think about both things. They'll think about non-correlation and they'll think about wariness. It will sort managers. It will create demands around terms. It won't lead to a mass exodus from the sector, but it certainly won't lead to a pouring of money in either. I think there'll be a lot of careful behavior.
Sure. Which is healthy as well. When you're looking back on some years that have been more challenging, it's healthy that people would be more wary going forward. So, but very interesting.
It wouldn't be doing their job otherwise. Good Absolutely, grief. Yeah. And meanwhile, they should expect more from managers. This is, the sector grew from, ballpark 10 billion around the financial crisis to ballpark 100 billion after 2017. There were a lot of, forgive me, but there were a lot of soft market geniuses. We'll learn more.
Yes. So on that note, you mentioned Florida, and we have a very important renewal coming up for the ILS and broader reinsurance market. How is the Hudson underwriting team looking at this right now? And we're hearing lots of reports of underwriters potentially downing their pens and not being so enamored with some of the terms and pricing that are being presented to them. What's the experience like on your desk?
Well, the Bermuda team is, of course, the team that looks at this, and they're deeply engaged and interested in the opportunities. And there does seem to be a late in the game squeeze in securing the final bits of coverage in Florida, late in the month of May. But there are 3 things going on, and the trade press covers one well and one okay. The one the trade press covers well is the horse race around pricing. It's pricing up 10%, 20%, 30%. There will be some 20+% pricing opportunities, some up more than that will seem interesting on the face of it. The second thing that the trade press has dug in more in this season that I'm happy to see more dialogue about is terms. Specific resistance to cascading covers, specific demand for co-participation, specific demand for pandemic exclusions. There's more debate about terms and more seeking of alignment, which I think is very constructive. And I know my team is thinking about those issues. The third issue that is still, I know, top of mind in our team is looking at loss on lines and calibrating those against the losses that we've seen. We have companies showing up with programs where they show a loss curve, but their realized losses on Irma are the 1 in 100 event, which of course has instigated the usual parlor game. at Hudson Structured of what exactly was Irma. So, it was certainly less bad than Andrew, 1928, 1926, probably Wilma, and certainly less bad than Donna. So those are 6 events. Then we talk about King in the 1950s. We think it probably was less bad than King, almost certainly less bad than 1947 Fort Lauderdale and 1944. And we're having an ongoing debate about whether the 1921 Tampa Bay hurricane was worse, which seems pedantic, but when you have a stochastic model showing that the 1 in 100 estimate is equivalent to the loss on a storm, where you can look and see anywhere between 7 and 9 storms in the prior century exceeding, and where you have a drift against you from climate change, we think hard about that. Then we have to re-rate. Then 20% up might seem great, except that the whole price is wrong to begin with.
Yeah.
So those are some of the thoughts. The folks in Bermuda do the coverage, but we've actually assigned an analyst to do specific investigations of Hurricane King in 1921, because we don't like to get lost in a stochastic haze. We want to know what we're writing.
That's really interesting. And so, final question for you: looking forwards through when you're looking back on this pandemic, will the priority change at all for Hudson Structured? Will you be just as focused on providing sort of a broad access to insurance and reinsurance linked returns for your investors?
Our mission is to find attractive investments across the spectrum that are lightly correlated with the broader markets. That was already a mission that we found exciting Jan 1, because so many sectors had hardened over the past couple of years. That will be more impactful going forward. That's what we'll be seeking to do. The industry has a mission. The industry has a mission that flows from this, that flows from the fact that the industry still has a 20th century coverage model based on physical facilities, and then other factors like business interruption that arise from physical damage. And the industry needs to move its paradigm into the 21st century, where companies are more concerned about customer lists and business processes and interruption and cyber risks and intellectual property. Nearly 80% of the assets of the S&P 500 are intangible. So I said that, around runoff, this event was an accelerant. And around digital transformation, this event is an accelerant. Perhaps this will be an accelerant for the industry in realigning its coverage model to the actual needs of companies in this century. We're trying to do that. We're focusing a lot of energy on cyber. We're focusing right now on intellectual property insurance, and of course, thinking hard about not just dealing with business interruption effects on existing coverages, but what the BI model will be going forward. So that will also create opportunities for capital.
Great. That's a really good way to end the interview. Thank you, Mike. I really appreciate you sparing me some time today. It's been great to talk to you, and I hope to catch up with you in person soon.
Thank you, Steve. I hope we can. Look forward to it.
Cheers.
Thanks.
Bye.